Stop. Do not touch your position. I know what it feels like to watch silver bounce 3% from the bottom after an 8% single-day collapse. I know that 3% recovery looks fragile. I know the doubt is creeping in. They want you to believe Friday's bounce is a dead cat. They want you to believe that $84.55 cannot hold after the carnage of this week. They are wrong, because what you are watching right now is not a dead cat. It is a compressed spring sitting on one of the most critical technical battlegrounds of the entire 2026 precious metals cycle. It is Friday, March 6, 2026. Silver is trading at $84.55, and in less than 90 minutes, the February jobs report lands. Ladies and gentlemen, Stacker here. The bounce is real. The battle is now. You need to understand what happens next. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow John A.G. World for the latest analysis. Let us cut to the technical anatomy of what silver has built this week, because the structure tells a completely different story from what the panicked headlines are screaming. The week's price sequence. According to reports, silver's week ran as follows. Monday, March 2nd, the metal surged from approximately $80 to a peak of $96.40. Single session gain approaching 20%, driven by the war premium. Tuesday, March 3rd, silver collapsed from that peak toward a $79.16 intraday floor, a drop of approximately $17 from the Monday high. Wednesday through Thursday recovery. Silver rebounded from the $79.16 floor toward $82 to $84. Friday, March 6th bounce. Silver has recovered to $84.55, a 3.1% gain from Thursday's session, as safe haven demand reasserts ahead of the NFP release. The critical floor at $79.16. According to analysts, the $79.16 level held as the bounce origin on the 2-hour timeframe. Market trackers confirm rejection wick clusters at that level. Multiple sessions where sellers arrived and were met by buyers with enough force to reverse direction. A rejection wick cluster is a technical fingerprint of institutional absorption. That is not a weak floor. That is a defended floor. The 50 EMA battlefield at $85.45. Sources confirm silver needs to clear the $85.45 zone to shift the near-term structure toward the bull side. This is where the 200 EMA sits on the 2-hour chart. This is also where prior consolidation occurred, meaning market participants who entered at this level previously now hold overhead supply that must be absorbed before the recovery arc can extend. With conviction. The RSI recovery. According to analysts, the RSI recovered into the mid-40s from a near 30 reading at the bottom of the flush. Mid-40s RSI inside a recovering structure means mechanical selling has exhausted, but buying conviction has not yet established directional control. This is the exact RSI configuration that precedes breakouts when a triggering catalyst arrives. The catalyst arrives at 1:30 p.m. UTC today, February NFP. The moving average divergence. Sources confirm the 50 EMA is sloping downward, while the 200 EMA remains flat on the 2-hour timeframe. A downward sloping 50 EMA inside a larger uptrend means short-term momentum is bearish, but the primary trend is intact. When the 50 EMA recrosses upward through the 200 EMA, which requires price to sustain above 85.45, the short-term and long-term signals realign. That realignment historically marks the beginning of the next momentum acceleration phase. Recovery path above 85.45. Analysts note that breaking 85.45 opens the path toward 88, and then $91.17. Below that, failure at 85.45 risks a retest of 82, and then the structural floor at 79.16. These two paths open within hours of today's NFP print. 4 fundamental dynamics intersect at Friday, March 6, 2026, all exclusive to this script, none carried from previous analysis. Dynamic 1. The NFP binary, the most consequential labor print of the war era. According to reports, the Bureau of Labor Statistics releases February non-farm payrolls at 1:30 p.m. UTC Friday. The consensus expectation clusters around 58,000 to 65,000 jobs for February, representing a dramatic deceleration from January's 130,000 print. The unemployment rate is expected to hold at 4.3%. Average hourly earnings are projected at 3.7% year-over-year growth. Sources note TD Securities analysts expect job gains to moderate to 90,000 in February, above consensus but still sharply below January. Average hourly earnings at 0.4% month-on-month represents the high end of analyst forecasts. The NFP context that makes this print uniquely important for silver. According to reports, gold is on track for its first weekly decline in 5 weeks. The Middle East conflict is simultaneously pushing oil prices higher, elevating inflation concerns, and reducing Federal Reserve rate cut probability at the March 18th meeting to just 4.4%. This creates the most complex NFP backdrop of 2026. War premium fighting dollar strength, inflation signals competing with labor softening signals, all colliding on the same day. Silver is attempting recovery from its worst single-week reversal of 2026. Dynamic 2, federal government payroll contraction, the hidden NFP wildcard. According to reports, January's 130,000 headline masks significant internal weakness. Federal government employment lost 34,000 jobs in January, as workers who accepted deferred resignation offers came off federal payrolls. Sources note immigration restrictions have constrained labor supply, while tariff uncertainty, AI-related disruption, and fiscal policy uncertainty have collectively suppressed private sector hiring. Analysts project payroll growth to average approximately 60,000 per month across 2026 under this framework. If federal government payroll contraction continues in February, the headline NFP could undershoot even the depressed 58,000 consensus, a scenario that would collapse dollar strength and release silver's next upward leg. Dynamic 3. Gold's first weekly loss in 5 weeks in its silver transmission. According to reports, gold is experiencing its first weekly decline in 5 weeks as war-driven oil price surges rekindle inflation concerns, suppressing rate cut bets. Silver's first weekly loss in 5 weeks mirrors gold's pattern exactly. Analysts note silver's beta to gold amplifies both upward and downward moves. A first weekly loss in 5 weeks for gold inside a structural bull trend historically marks a pause, not a reversal. The question is whether the pause extends or resolves within days depending on NFP's outcome. Dynamic 4. The DXY 5-week high and its mechanical silver ceiling. According to reports, the US dollar index climbed to a 5-week high of 98 on Thursday, March 5th, following strong ISM services and ADP data reinforcing the higher-for-longer narrative. Community trackers confirm the mechanical relationship. A stronger dollar raises the cost of silver in every non-dollar currency simultaneously, reducing purchasing demand from Asian, European, and emerging market buyers in real time. The 98 DXY level is the ceiling silver's recovery must fight through. If NFP softens the dollar back toward 97, that mechanical headwind reverses into a tailwind, releasing the metal from its dollar cap. The emotional landscape inside silver on Friday, March 6th captures the exact moment when two different holder populations simultaneously grip the same metal, with opposite convictions about what comes next. Population 1. The recovering tourists. These are investors who entered silver between $80 and $96 during Monday's war premium surge and survived Tuesday's crash. They are watching 84.55 and asking the same question: dead cat or genuine recovery? Their conviction is fragile. According to reports, Tuesday's 13% 2-day reversal watched a 20% single-session surge erase itself completely within 48 hours. The psychological damage of witnessing that sequence is significant. Their hold discipline is being tested every hour between now and the NFP print at 1:30 UTC. Population 2. The structural diamond hands. According to analysts, COMEX silver futures are exhibiting backwardation, futures trading below spot price. This means buyers are paying a premium for physical silver delivered immediately rather than accepting future delivery at a lower price. Sources confirm that short covering rallies do not create backwardation. They push paper futures prices toward or above spot. Backwardation emerges when physical demand creates urgency that paper markets cannot replicate. Structural holders who understand backwardation are not selling $84 silver into a physically tight market. They are adding the sentiment thermometer, RSI mid-40s on the 2-hour time frame. Not capitulation. That was the sub-30 reading at 79.16. Not overbought. That was the 90-plus reading at Monday's peak. Mid-40s is the neutral rebuild zone where emotional exhaustion has burned through but directional conviction is waiting for its catalyst. Today's NFP is that catalyst. The most revealing sentiment signal of the week. According to reports, when oil-driven inflation fears hit Tuesday, the dollar surged as a competing safe haven against gold and silver. Traders raised cash, the safe haven of absolute last resort, the asset sought when investors believe every other position is simultaneously overpriced. When precious metals and equities sell together in favor of cash, the selling is mechanical and temporary, not fundamental and structural. Mechanical selling targets every liquid profitable position simultaneously based on margin pressure. Tuesday was mechanical. The silver supply deficit of 67 million ounces for 2026 is unchanged. The structural thesis is intact. According to analysts, the RSI bouncing from near 30 back to mid-40s confirms mechanical selling exhausted at the 79.16 floor. The next population to control price is whoever gets their catalyst confirmed. NFP miss delivers for structural bulls. NFP beat extends tourist uncertainty another week. Let us dismantle the most dangerous Friday narrative circulating about silver on March 6th. Because accepting it without examination means misreading every price signal until the next breakout. The dangerous narrative. Silver's bounce from 79 to 84 is pure short covering, not genuine demand. According to analysts, open interest on COMEX silver futures declined even as price bounced from $63 to approximately $82 in the February to early March window. A rising price alongside declining open interest is classically interpreted as short covering, trapped shorts buying back positions, pushing price higher without fresh capital entering. If the bounce is exclusively short covering rather than new demand, the rally has a ceiling and collapses when covering exhausts. 3 compounding errors in this argument. Error 1. Backwardation is incompatible with a purely short covering explanation. Sources confirm COMEX silver backwardation, spot commanding a premium over futures. Short covering pushes futures prices upward relative to spot, the opposite of backwardation. Backwardation is created when physical buyers compete urgently for immediate delivery above futures price. Physical urgency and paper short covering produce opposite market structures. Backwardation is occurring. Therefore, physical demand, not purely paper mechanics, is contributing to the current price floor. Error 2. The labor market trajectory is structurally dovish regardless of this week's dollar spike. According to reports, January's 130,000 NFP beat consensus of 70,000 significantly. Yet that headline strength concealed 34,000 federal government payroll losses and a benchmark revision of 862,000 fewer jobs in the 12 months through March 2025 than previously estimated. When headline strength masks underlying weakness at the benchmark level, the Federal Reserve's higher-for-longer narrative sits on softer foundation than the DXY's 5-week high suggests. Structural rate cut probability over a 6 to 12-month horizon is unaffected by 1 week of oil-driven inflation repricing. Error 3. Crypto performance remains the definitive comparative. According to reports, Bitcoin held above 71,000, Ethereum consolidated near 2,000, and XRP drifted sideways, all described as trading cautiously near key support after roughly 2% pullbacks. Silver is down approximately 12% from its Monday peak, and has recovered 3.1% on Friday. Bitcoin is roughly flat versus pre-war levels, having not captured meaningful crisis safe haven flow in either direction. The asset class that experienced massive crisis demand was precious metals. The asset class that experienced moderate correlation drift was crypto. When capital seeks structural allocation post-crisis, the destination that absorbed geopolitical fear flow returns to outperformance. That destination was silver, not digital assets. The most relevant comparison for Friday, silver tracking its first weekly loss in 5 weeks from a peak of 20% single-session gain. Bitcoin tracking its 4th+ week of directionless consolidation around the same price range it held before the war began. One asset demonstrated crisis safe haven magnetism and is now consolidating that gain. One asset demonstrated crisis irrelevance and is consolidating nothing. The NFP War Room. 5 levels, 3 scenarios, 1 battle plan for Friday, March 6th and the week ahead. Level 1. The Structural Fortress, $79.16. Sources confirm this is the confirmed bounce origin, the price where multiple rejection wicks formed and institutional buyers defended the zone against sellers. A return to $79.16 on elevated volume is a second structural entry point for long horizon holders, not a panic exit trigger. The thesis breaks only on a sustained daily close below this level. Level 2, the early warning line, $82. Analysts note 82 is the first support above the structural floor. A daily close below 82 following an NFP beat confirms dollar-driven selling has reactivated and a retest of $79.16 becomes probable. Diamond hands use this level as the structural warning signal, not the exit. Level 3, the gate, $85.45. Sources confirm this is where the 200 EMA sits and where prior consolidation created overhead supply. A daily close above $85.45 following a soft NFP is the single most important price signal on Friday. It confirms the bounce is real, the resistance is absorbed, and the path toward 88 and 91.17 is open. This is the line in the sand. Level 4, the recovery confirmation zone, $88 to $91. According to analysts, clearing $85.45 targets $88 first and $91.17 second. Sources note that a daily close above 84 on the daily timeframe confirms a cup and handle neckline formation and opens the technical path toward $100, a psychologically significant level potentially achievable by mid-March if momentum sustains. Level 5, the activation gate, $95 and beyond. Analysts note $95 is where COMEX registered inventory pressure begins, momentum algorithms engage, and retail FOMO participation arrives. Long-range analyst targets in the range of $120 to $150 for 2026 were established before this week's consolidation. According to reports, those targets have not been withdrawn. They are deferred by the week's mechanical flush, and will be reinstated when price structure confirms the next advance. Scenario 1, NFP misses. Prints below 50,000. Unemployment rises to 4.4 plus. Dollar retreats from 98 toward 97. Silver breaks above 85.45 on Friday's session. Weekly close above 85 confirms recovery arc. Path to 88 opens within Monday's Asian session. The bounce at 84.55 was the right entry point, not a trap. Diamond hands who added between 83 and 85 on Thursday and Friday see first target within 3 trading sessions. Scenario 2, NFP meets consensus, 58 to 65,000. Unemployment holds 4.3. Dollar stabilizes around 98 without accelerating higher. Silver consolidates between 82 and 86 through the weekend. The recovery is delayed but structurally intact. Holders accumulate additional positions in the 82 to 85 band. Monday morning becomes the next catalyst decision point, with CPI March 11th as the next major binary. Scenario 3, NFP beats, prints above 100,000. Dollar spikes toward 99. Silver tests 82 and potentially retests 79.16. This is the backup truck scenario. A second opportunity to load at the structural floor that confirmed as bounce origin on Tuesday. Per backwardation signals and 67 million ounce annual deficit fundamentals, a second retest of 79.16 is not structural failure. It is the same structural opportunity at a slightly lower price with an additional week of confirmation behind it. What did NFP print? What is your call, miss, meet, or beat? And which scenario are you positioned for? Drop your answer in the comments. This is Stacker out. 84.55 is the bounce. 85.45 is the gate. The spring is wound. Stack accordingly.